Good morning, everybody. Thanks for joining us live today on our webinar to discuss investments for U.S. citizens who are resident in Canada. I'm joined today by my partner, Warren Dueck, who resides in Vancouver, and I am Krista Rabidoux, and I operate out of Calgary office primarily. We're going to be discussing just high level some of investments and the tax reporting for each of those. We're not necessarily financial advisors on what's the best investment return for money, but we're going to focus a lot on the tax implications on different investments. Throughout the webinar today, you have the opportunity to ask some questions that you feel you need answered, that if we have not addressed them. Thanks to everybody who posed questions in advance. We appreciate that. And we're going to try to aim throughout our webinar today to answer some of those questions. You'll see down below there's a Q&A. If you have a question, please make sure just to type your question in there. And then at the end of the webinar, we're going to leave time for answering some questions. And one of our senior managers, Kathy, will be letting us know what those questions are so we can address them. As soon as we're done the survey, you will also receive a link to a survey to complete. We ask that you please complete that survey. Provide us any feedback on what we can do better, what we can do different, any other topics you may see or questions that you feel you left unanswered. If you do have a question that was left unanswered, please make sure to provide your name in that survey. Also, there is the ability for closed captioning for those who also want to be able to read the transcript as we talk. You'll notice on the bottom of your bar the live transcript option. Please just make sure you select that if you want closed captioning throughout the webinar as well. So today we've got a wide variety of issues we're going to talk about with you guys. And primarily it's going to report what is the reporting requirement for different Canadian investment tools that exist, as well as US investment tools. What's the implication of having those while you're resident in Canada? We're going to focus on some of the main investment options that are available that create some, I guess, hiccups, if you will, when reporting, such as mutual funds, life insurance policies, municipal bonds. What do you have to do if you plan to own one of those things? We're also going to talk about what's the difference, what's the similarities in reporting for RRSPs versus an IRA account or a 401k. Or what do you need to do if you move to Canada and have those investment tools? It's important to understand the different reporting requirements that exist in those situations. Also, TFSAs and RESPs. What's the reporting for those? There's so much talk about, do I need to report those? Do I not need to report those? How's the income taxed? What is the best idea? When is it the best idea to invest in those tools? Or is it ever a good idea to use those tools for investment purposes? So it's a matter of looking at kind of a holistic picture on, if I have these, what do I need to report? What do I need to pay tax on? And does it make sense to actually own those investments, all these different investments that exist? Like I said, we're not necessarily going to be giving financial advice because we are not financial advisors, but giving you an implication on, from a tax perspective, when it might be a good idea to avoid these scenarios or when it might make sense to actually invest in some of those scenarios. I'm going to pass it off to Warren, who's going to kick us off and start us on this presentation.
Great, thanks very much, Krista. Our focus here is on tax issues associated with U.S. citizens resident in Canada. They've got a unique situation because they're taxable on their worldwide income in both Canada and the US. And that's where the problems happen typically. And I know we have a lot of investment advisors on today with us here, and others who are other advisors, or you're actually a US citizen resident in Canada, or you're thinking about that might happen to you, either moving to Canada or becoming a US citizen, something like that. As Krista said, we're not giving financial advice, but we are giving you tax advice, and that can impact the decisions you make. Canada and the US have a lot of similarities. We speak the same language, we kind of cheer for the same sports, but they're not exactly identical. Like in Canada, we have 3 downs when we play football, but in the US it's 4 downs. And what you'll find here is on the tax side is, well, there's a lot of similarities. It's the differences that count. So the biggest mistake you'll make as an advisor, as an investor, is saying, oh, well, this is what happens in the US, the same must be true in Canada, or the same must be true in the US. That's the big mistake here. And we'll walk through these subjects. We'll start with passive foreign investment companies, better known as PFICs. This is the only subject we're going to cover today that we actually gave 2 slides to, because it's probably creates the most problems for most clients is PFICs. And they might not know they've got a PFIC or not, but they know they invest in things like Canadian mutual funds, exchange traded funds. And there's a lot of other things that can also be passive foreign investment companies. So to start this off, I want to tell you firstly how you identify a PFIC. A PFIC is a non-US corporation that either has 75% gross income as passive, or the average assets are 50% passive. Now, you're going to stop me and say, hey, Warren, I invest in a mutual fund, but it's a trust. It's not a corporation. This is where the problem begins. Remember, the issue here is what US tax law says that is. So a Canadian trust that conducts a business activity is not treated as a trust for US tax purposes. It's treated as a corporation. And because of that, Canadian mutual funds, typically, I can't say I know all the Canadian mutual funds, but they're usually formed as trusts. They are treated for US tax purposes as a corporation. And since they were organized and managed outside of the US, they're a non-US corporation. So trusts are taxed as corporations for US tax purposes where they conduct a business activity. And the business activity that's being conducted is they're actually managing investments on behalf of clients that pay them a fee for that. So anytime you have a non-US corporation, remember it's under US rules, you can have a PFIC. And PFICs, there'll be a PFIC if over 75% of the gross income is passive. Now, passive income typically involves things like investments. So, dividends, interest. It can also involve rents. Rents have some special rules associated with them, and we'll talk about those a little bit later. But so, rents can be a problem too, royalties, other things that there's not a business activity that gives rise to it. In other words, it's not like you're selling widgets and you're getting a return on those. So that's passive income. Now,
Warren, sorry, go ahead, continue.
Okay, so that's the one of 2 tests is if over 75% of gross income is passive, it's a PFIC. Now remember, it's gross income, not net income. So this is a problem for companies that go out and raise $10 million to find the cure for cancer or the common cold. They probably don't raise 10 million, they probably raise a multiple of that. They raise $10 million and they work away at this for the next 5 years. And what sort of income they have? They did not make a sale during that period at all. They made interest income. They had $1,000 of interest income each year, and that's all their gross income. They'll meet the PFIC test. So again, PFICs include things other than mutual funds and ETFs. And so they can naturally trigger into that. The other test here is if their average assets are more than 50% passive. Now that's kind of a strange test. We think about this very much, but what is a passive asset? Well, investments would be a passive asset. And probably the biggest problem with passive assets here is cash is a passive asset for this purpose, even where it's in the working capital of business. So you have to look out for businesses that have investment assets and cash. They'll probably be a PFIC, or I should say they may be a PFIC, and there's some other things we'll talk about here. Krista, do you have some comments on that?
Well, no, I think, I mean, you noted that about the cash. I think that's where we run into one of the biggest issues sometimes when we have service corporations who collect a lot of cash in their corporation. And, you run into a bit of an issue if you go over 1 year. And Warren, you might refer to this later, but once you become a PFIC, you're forever a PFIC. So you taint yourself 1 year. And you're kind of in trouble for the rest of it. So I think a lot of time with the cash, we see them in service corporations where they keep a lot of cash, but they don't really have any other assets.
Yeah, Chris, that's right. The rule is here basically, and it's not 100% true, but you should think about it this way. Once a PFIC, always a PFIC. Now, with mutual funds and ETFs, they're going to be pretty much by design PFICs. But the problem is with a lot of other entities, and I'll talk about that just briefly here in a moment. Firstly, the PFIC rules only apply to U.S. persons. So if you're a U.S. citizen, you're a U.S. resident, you're a green card holder, even if you're a green card holder living in Canada, those PFIC rules apply to you. And so any U.S. person they'll apply to, but they don't apply to individuals who are not a U.S. person and are, let's say, a resident of Canada or a resident somewhere outside the U.S. Also, controlled foreign corporations are not PFICs. And there's one exception there, but a controlled foreign corporation is similar to Canada's FAPI rules. The US equivalent is the controlled foreign corporation rules, where it says if you own more than 50% of the shares or value of a foreign corporation, for US tax purposes, it's a controlled foreign corporation. And a controlled foreign corporation is not a PFIC, except if it's a PFIC first. In other words, if a PFIC becomes a controlled foreign corporation, then you end up in pretty much the worst place of all worlds of being subject to both the controlled foreign corporation rules and the PFIC rules. Now, people ask me the question, well, would I rather be a controlled foreign corporation or a PFIC? Generally, I'd say both sets of rules have some bad attributes to the taxpayer. But generally the CFC, the controlled foreign corporation rules, it's easier to plan around. The PFIC rules are tougher to plan around and can pack a real punch on the back end. I just want to explore this area of if Canadian mutual funds and ETFs are PFICs, then what else is a PFIC? Well, think about this. It's basically any company that has a long earnings cycle. What I mean by that is they start the business and it may take them several years before they have income. So we talked about a biotechnology company. That's an example of that would commonly have a PFIC problem associated with it if there's US investors in that company. A mining company, it acquires a mining site and builds before it actually starts operating and mining, it may take several years to do that. Agriculture is a common problem in this area. That has the same issue, that you plant your cranberries and 4 years later you have your first crop. There are some exceptions to the PFIC rules, but those are actually pretty short-lived. Like if you're a PFIC for the first year, but not after that, then you're okay. But those are problematic in, like I say, businesses that have a long earnings cycle. The other category I want to just address your attention to is particularly prevalent in professional businesses. Now, it would apply. Remember I said if you're a controlled foreign corporation, you're not a PFIC. Well, what happens when a husband and wife each own shares of the corporation? The husband has 50%. And the spouse has 50%. And it's in, for example, they're a realtor or an accountant or a lawyer. Now, there's some restrictions about stock ownership in those cases, but where there's 50-50 split, it will not be a controlled foreign corporation where the other spouse is not a US person. But it's probably going to be a PFIC because what do professional corporations have? Well, they've got a few assets, like they've got some desks and chairs, but they probably have either a lot of cash or investment assets. So that's a real trap for people, is in that category.
I'm going to touch base one thing here, because often sometimes I hear as well, well, I'll just set up a corporation to hold my mutual funds, and then I don't have a PFIC. And that's actually not the case, because as US persons, you're deemed to own everything that your corporation owns. So you get in a situation, as Warren alluded to earlier, potentially where you have a PFIC and a corporation CFC. You now have a CFC, but if you own PFICs within that corporation, mutual funds, ETFs, et cetera, you're stuck still reporting all of those individual PFICs on your personal return. So it's not necessarily a shelter from the reporting, if you will.
Yeah, that's a great example, Krista. That is a problem. Using a corporation to hold PFICs doesn't solve your problem. It probably magnifies them.
That's right.
So what's the problem with PFICs? I mean, we've talked on about PFICs, they're bad. So what's the problem? Well, firstly, the gain is prorated over the ownership period. So you buy into a PFIC for $1, and for the next 10 years, it's still worth $1. There's been no increase in value. But at year 10, now it's worth, $1 million. US tax law on PFIC treats it that you've actually earned that gain pro rata over the last 10 years. You say, well, that just wasn't true. It doesn't matter what's true. We know that tax law doesn't necessarily go on what's true. This is how it gets taxed. And you'd be subject to tax at the top interest rate in each one of those 10 years. And worse yet, there's an interest charge on the deferred tax. You said, I didn't defer tax. I didn't sell the stuff until 10 years later. But US tax law treats it as though you were taxed over those last 10 years. And there's some foreign tax credit limitations on that too. So, these are all not good things. I think you agree on that they're not good things. There's some other limitations too. PFICs are problems. Now, from the question we get asked by a lot of people, should I invest in PFICs? Well, sometimes you really don't have a choice. If you're a small investor and, you can avoid PFICs by investing directly in equities and not in PFICs. But if you're a small investor, you're not going to get any diversification by doing that. As Krista said, we're not your investment advisors here, but that may not be a great idea. So you may have to live with these things called PFICs and find solutions for them, if you will. One of those solutions is something called a qualified electing fund, or QEF, QEF. So you can make a QEF election, a qualified electing fund election, in the year you purchase the interest. You have to do your tax return for that year by the filing deadline of that return. If you don't do it, then you end up in this strange world of pedigreed and unpedigreed QEFs. And that makes tax people sound like heart surgeons. But so you really want to do that in the year of purchase. So you need to alert people to the fact you've bought this mutual fund and whether you should make that election. Now, what the election does is it says that you must pay tax in each year that the fund earns income. The critical fact here is that in each year it earns income under US tax principles. And that's where the problem can come, is that when you talk about US tax principles, there's two aspects of that. One is a foreign exchange difference. In other words, you're going to be doing everything based on US dollars. You say, well, that's not a big problem. But sometimes there are differences in tax basis and assets, and the gains can be fairly wildly different. So that's one problem. The other one is where you have a situation where there's an event that, for Canadian tax purposes, for example, a merger or amalgamation or some corporate transaction that does not trigger tax in Canada, but that same transaction is taxable for US tax purposes. So these can kind of bounce out of line here. Now, what I'd say the good news is I've never seen, I don't know if Krista, if you've seen a wild swing between the Canadian and US tax results, but that's this solution, and I put that in quotation marks, is not perfect. And so you need to be aware that there's not a silver bullet here that solves your problem. There's another alternative called mark to market, and that is that basically you recognize a gain every time your the value of your PFIC, and these will have to be like mutual funds and ETFs, goes up in a year and down a year. So you've got this bouncing thing where if it moves around, we do not use the mark to market very much. In fact, we try to avoid it. Generally, the solution here is the qualified electing fund. The last alternative is the purging your PFIC status. Now, this has a whole bunch of other ramifications. It means you're going to recognize gain on something. You'd only do this in a situation where your investment has ceased to be a PFIC. It's the mining company that it took 5 years to start mining operations, and now in the 5th year, it's actually making sales and it's no longer going to qualify as a PFIC under that term. So for you, it's still a PFIC until you purge its PFIC status, but the company has lost its PFIC status because it's operating that business is going full tilt.
And the thing with the purge is you're basically bringing forward a gain that's not necessarily, it's a deemed income, right? So, but in the long run, might be beneficial to do. Yeah,
these are, like you say, there's no silver bullet here. And for the small investor, they probably don't have a choice but going into mutual funds and ETFs. As someone's investment base gets larger, investing in equities can become a better solution. But remember, equities can be PFICs too. And for example, some of you in Vancouver may recall Quadralogic, which was a biotech company, and it was a PFIC. And in other words, you don't avoid being a PFIC because you're traded on the New York Stock Exchange. You can still be a PFIC if you're a foreign corporation and you meet those other criteria. And the interesting thing is these rules have been around since 1986. I remember when the PFIC rules came into place. I'm that old. And that was Ronald Reagan. But the IRS did not pay any attention to these subjects until about in the 2000s. They didn't publish a lot. There were some regulations they issued, but the one group who did was the U.S. Securities and Exchange Commission. They forced companies to identify whether they were a PFIC or not. And so oftentimes, if you want to find the answer to this question, get an SEC report issued by them, and you can get that through your investment advisor. So it'll identify whether it's a PFIC.
Yeah, that's a really good point, because a lot of people just think about mutual funds and ETFs and avoid, but it could be stocks that you own too, if the corporation's potentially passive, right? So it's not
like
it's
I
not
say,
blanket.
Yeah, one company I can say almost 99% of the time they will be a PFIC, penny stocks. Now Vancouver used to trade this used to be a big issue in Vancouver. It's I don't say it's gone, but it's not as common as it was before. But penny stocks, and that includes anything that trades over the counter that's a foreign corporation in the U.S., a foreign corporation outside the U.S., a non-U.S. corporation. Penny stocks have a really high risk of PFICs. Again, just think back to the rules. They've got a plot of moose pasture in northern Canada, and $1,000 in their bank account, and it's that bank account that creates the problem. They're not earning any income. Let's flip to the next subject here. We could talk forever about PFICs, but I even get tired of that too. So REITs, real estate, and private equity. Well, this is a huge category, and we could have spent a week on this, but we gave it one slide just to kind of talk about this issue. Again, we're trying to highlight issues that can be problems for U.S. citizens resident in Canada. Canadian REITs. Now, you'll say this is the same subject as PFIC. Say, hey, these are trusts. But for U.S. tax purposes, they're going to be treated as corporations. because what are they doing? They own a building, they manage the building, and they're going to be a corporation. So a distribution from it, from U.S. tax purposes, are dividends. And you need to think about how it's being taxed there. And probably one of the bigger problems we have with real property, and I kind of tipped you off as we talked about rents can be P-fixed too, is that if you've got a big fund, a REIT that buys property, they buy a shopping center, Park Royal in West Vancouver, or Chinook Mall in Calgary, or same sort of thing. If they buy the property and then have it managed by a third party, it will be a PFIC, because this constitutes, I know you love to have acronyms and strange tax words, but this will end up being foreign personal holding company property for U.S. tax purposes if it's managed by a third party. If the REIT actually manages the property, in other words, they're not just, checking their bank account, that they're actually the guys, their employees are sweeping the floor and their employees are picking up the garbage and things like that, it won't be a PFIC on that. Often what happens, of course, with REITs is they've got multiple properties. So you have to do that analysis for each of the properties and then figure out, do you meet the test, those two tests we talked about earlier. That can be very difficult to do. So be conscious of that.
Yeah, and Warren, I think that's a good point. It can be difficult. And where do you get that information? How do you know? And I think when you're investing, you really need to also become somewhat of a financial analyst and understanding financial statements and the expenses in there to determine whether or not you have a PFIC or not.
Well, yeah, and that's great. One of the things, you always have to evaluate. I mean, the number one issue here, tax is not the most important thing you do as an investor. It's to maximize your return. On the back end, you want to make sure that tax doesn't eat up all of it. So your goal here is to maximize your return, not to eliminate your tax liability. You want to have your tax liability as low as possible, and you want to avoid it destroying your return.
Well, and not just the tax, but the administrative cost of owning it as well.
Well, yeah, and by administrative cost, what Krista's really saying is the cost of professional services like ourselves. Yeah. I mean, we do look at these situations, and we've got one project, for example, we'll spend $30,000 or $40,000 a year analyzing whether or not it's a PFIC. Now, it's a larger holding, and it happens to be a private holding. But it is difficult to get that information. And, if you're a $10,000 investor in this entity, absent any sort of SEC registration, you'll find it really hard to get that analysis.
Yeah.
I can give you probably a pretty good guess based on looking at some financial information, but the precision here is going to be kind of low. So you're kind of on your own in that respect. And as an advisor, you need to be conscious saying, what am I advising my client to get into? So I'll switch to real estate and private equity. This is, of course, a broad field. I gave it half a slide here. And again, this could be the subject of a week's seminar. I'll just kind of hit the highlights here, and you'll have to forgive me for, we're hitting this from 30,000 feet, maybe somewhere in outer space. Canadian U.S. limited partnerships have the same result. In other words, they're both treated the same for Canadian U.S. tax purposes. What's not treated the same are limited liability companies and limited liability partnerships, LLPs and LLCs. For U.S. tax purposes, they're virtually always treated as partnerships. You can elect to treat them as corporations, but they're virtually always treated as either as partnerships or something called a disregarded entity. In other words, they're kind of ignored from a U.S. tax perspective. But for Canadian tax purposes, they're treated as corporations. And the difference is this, is that when an LLC sells real property, for U.S. tax purposes, it's treated as a gain to the investor. But for Canadian tax purposes, the amount paid out is treated as a dividend. And that difference becomes really important here. It's taxed. The gain for Canadian tax purposes would generally be taxed about a 25% rate, that capital gain. But it's not a capital gain for Canadian purposes. It's a dividend, and it could be taxed at rates up to 54%. So it's a huge difference. LLCs and LLPs can be recipes for double taxation. Now, that's not always true. And but for most situations, you should only ever go into an LLC or an LLP with a tax advisor, someone who understands cross-border tax issues on your hip on that subject, because you are in really dangerous territory from a tax side. And that's a situation where the tax result can basically destroy the investment. You know, the other part, when you talk about entities, even like a limited partnership, you have to look to say, what does it own? Does it own other partnerships? Does it own LLCs and limited liability partnerships? In other words, if you have an LLC in a limited partnership, you still have the same issue. So you always have to look downstream and saying, what does it own? Using a limited partnership doesn't solve all your problems. I'll touch base quickly here on the principal residence exemption. We had a bunch of questions that people ask on this, and here's just the real quick one. When a Canadian sells their principal residence, they're not subject to Canadian tax. When a US person sells their principal residence, they may be subject to tax. They can only exempt $250,000 US of gain, or if they're married filing joint, they can exempt themselves on $500,000. Now, even $500,000 seems like pretty small money on gains if you're in places like Toronto and Vancouver, which have really substantial real estate appreciation. So if your spouse happens to not be a US citizen, generally you want them to own the property because they wouldn't pay any Canadian tax and they're not subject to US tax. How do you do that? Well, typically that's a gifting program. You end up doing something like there, and unfortunately, that becomes a little too detailed for this discussion, but we'd be glad to work with you on that. The other thing you need to be conscious of is principal residence. Both Canada and the US use the same words. Here's another case where Canada and the US are so similar, they use the same words, but they mean entirely different things. In the US, principal residence really means the place you reside at. Like that's your primary residence. In Canada, it can mean the place that you normally live at, but it also means your vacation cabin or other places. So remember, you heard it from me, US tax, Canadian tax, a lot of similarities. It's the differences that count. So let's switch to the next slide here. And we'll just buzz through this really quickly. Life insurance and annuities. There's a 1% excise tax on premiums when a US citizen is insured by a non-US life insurance company. So if you pay $1,000 in premiums, you owe $10 in tax. Annuities are always based on tax deferrals, but remember they have to meet each company's rules. So annuities are big problems in cross-border situations. And if you buy an annuity in the US and move to Canada, you may not get the result you want. Similarly, if you're a US citizen living in Canada and you buy one in Canada, the question is, do you get one? Do you get a tax deferral in the US? So that's a problem. Municipal bonds, they're fully taxable in Canada, so there's no advantage there. Flow through shares, there's no deduction in the US. And whenever you're talking about a tax benefit in Canada, your goal is to make sure your Canadian tax is always more than your US tax. And like $1 more would be perfect. Because once you drive your Canadian tax lower than the US, you're not saving money anymore. Your goal is to reduce your overall tax. Reducing your US tax to zero, your Canadian tax to zero, doesn't do you anything. Your goal is to bring your total tax down. So, Krista, I'll let you go from here.
And I'm just going to touch base on one more thing here before we kind of hop off the mutual fund, REITs, life insurance, etc. A lot of times US citizens come to us and say, well, you know what, I'm a US person, so I'm just going to open up a US brokerage account and do all my investing down there because I can do what I want. And, you know, you need to be really careful of having that mindset for two different reasons. One, we're not discussing today, but what are the implications of those investments in Canada? Because Canada may not treat them the same as the US. Two, you need to be careful under the securities what you're actually saying you are doing. Just simply using a US address doesn't make you a US resident under the trading regulations. So make sure you're talking to an advisor before you move forward with just saying, well, I can just use a US address, I'm a US person, and then make investments in the US to avoid the US reporting. So just something to be cognizant of before making that step forward. We're going to jump here a little bit the track into RRSP versus a individual retirement account or a 401k plan. And as Warren alluded to, there may be similarities, but it's the differences that catch you when you're looking at your reporting for the different accounts. And you know, when you're in Canada, the RRSP is the primary investment tool that a lot of people use when they may not have a private pension that they're contributing to, and they're saving for their future, for their retirement. And it is beneficial for US citizens to actually utilize an RRSP account and contribute it to reduce your Canadian income. Now, there's two things that you need to be careful of when determining what to contribute to an RRSP. If you have a large deduction limit, it may not be purely beneficial to you to contribute that large amount and reduce your Canadian tax so much that you're going to create US tax because you don't have enough tax credits that are available, because the deduction is available in Canada, but not necessarily always available in the US. So you need to be careful, really careful when you're balancing that contribution amount that you're making to Canada in order not to create, as we always term, the double tax, where you may pay tax now here and tax later in another jurisdiction. So like I said, the deduction needs to be carefully monitored. Still a good investment tool. The US allows RRSPs to continue to be tax-free until you start making distributions, and you reduce your overall tax amount. Now, distributions are going to be, when they start to happen, both taxable in Canada and the US. If you're still residing in Canada, when you receive those distributions, they'll just be reported on your tax return. Whereas if you've moved back to the United States and you start to receive distributions at that point, you're going to be subject to withholding tax on those distributions. The US, on the other hand, doesn't actually tax the full distribution. They only look at the incremental income gains that may have been earned in the RRSP. That's the portion that's going to be taxable in the US. Now, people say, how do I know what that is? Because that's a lot of tracking, that's a lot of monitoring for something that doesn't really matter for Canadian tax purposes. This comes back to what's the cost benefit analysis. You should track the income and gains earned so that when you are reporting income on your US tax return, you're only looking at picking up that differential for income purposes to report. And that then reduces your US income that's reported on your return. Similarly, on the opposite side, should I continue to contribute to an IRA or 401k? That option isn't necessarily available to you, nor is it a good idea once you move to Canada. For an IRA, you need to actually have US earned income to be able to contribute to it. So generally, you're not even going to be able to contribute to the individual retirement account, nor will you have an employer. So it's really individual based on that. You're not going to receive a deduction in Canada for those contributions. So there's no real benefit, if you will, aside from maybe some other investment strategies that exist in contributing to those while you're a resident of Canada. The distribution is going to be fully taxable both in Canada and the US. The Canada doesn't recognize the same type of rules that the US does with only incremental income. So you need to make sure you're cognizant of that when you start to receive distributions on the fully taxable position that Canada takes on those types of investments. And it always comes down to balancing that cost benefit when you're taking distributions. I have had individuals before who didn't to start taking their RRSPs until they've moved back to the United States when they retired. That in some instances may reduce your overall tax exposure, because the withholding tax in Canada might be lower than what your otherwise marginal rates could have been. And RRSPs are one of the exempted amounts for departure tax where you don't actually have a deemed reporting on leaving Canada. So there's strategies that you need to look at. And we've talked about this in other webinars before about when is the best time to recognize income, when is the best time to move, those types of things, so that you're looking at your picture on a holistic level throughout your years on planning where you want to be and what you want to do with your life in the future. Warren mentioned it earlier about don't let tax make your decisions for you. However, it's important to analyze your position and what's the best result for you as an individual to have the most cash in your pocket as possible at the end of the day. A lot of times we get asked, well, you know, I've moved to Canada, I have a 401k, I have an IRA, should I roll it into my RRSP? You know, that is it depends. Our favorite phrase is, as tax accountants, it depends. You really need to do an analysis, because what you don't want to have happen is the US is going to tax that distribution when it's made, regardless if you're rolling it into an RRSP or not. Plus, you're going to have a 10% early withdrawal penalty. So where you really need to look at this is, do I create enough Canadian income and create enough Canadian tax to be able to use the tax that the US is going to charge? Now, it doesn't mean that the RRSP is going to be includable, but it's one of those provisions where you actually get to offset tax on other income for the foreign tax credit because of the mechanism of how foreign tax is made. Also, you know, you need to think about the investment. It is possible to leave those investments in the US with the right advisor. It can stay an active account. It can stay, you know, making money down in the US. So you really need to think about what is the benefit of moving it to Canada? Why do I want to move the IRA into an RRSP? Is there a reason to do it aside from tax? Because it is going to create some tax complexities, and in some situations it might actually create double tax, because that RRSP in the future is going to be taxable. So you need to make sure you're able to fully utilize the foreign tax that the US is going to charge in Canada, or you're not going to end up in the best after tax position as a whole. You have anything to add there, Warren, on RRSPs versus individual retirement accounts?
Well, just on you talked about the SEC restrictions.
Yes.
U.S. investment advisors.
Yeah.
U.S. investment advisors can't advise residents of Canada, even though they may be a U.S. citizen.
Yeah.
There are some ways to avoid that restriction. That restriction is really not on the investor; it's on the advisor. So yes, it's a problem if you're a U.S. advisor and doing that, until that U.S. advisor makes it a problem for you. And typically what happens is, you know, that investment advisor in Los Angeles or Houston or New York, their compliance officer figures out their client is not a resident of Canada, and they freeze the account. Now that's where the problem is. There are solutions to that, but they tend to be more expensive solutions. In other words, setting up an entity and things like that, that may not be a practical answer. There are, and I know because we got a bunch of them on today here as attendees, there are quite a few investment advisors in Canada. When I say quite a few, that's a fraction of the total investment advisors, but that are registered both in Canada and the US. And so they give you some flexibility in that regard, but I'm not aware of, frankly, of any investment advisors in the US that are registered in Canada. I think that's quite unusual, actually.
You know, Warren, you made a point that it's kind of the investor's issue, but I will say that I know, like, there's some platforms out there that really make it a lot easier for people to self-manage their funds, whether it's with bank or some of the standalone brokerage accounts. At that point, it's you. So if you are now your own advisor, if you're making these investment choices, and so you really need to be careful, because it's actually quite risky to be breaking SEC laws. So
yeah. Should we talk about tax-free savings account?
We sure can.
Let's talk about-
Favorite gray area.
So I hate to think things are gray. I think they're a lot clearer than that. But the issue here is I want to talk about is tax-free savings account. Now, some of these things are obvious. They're tax-free in Canada. They're not in the U.S. And there's a lot of U.S. citizens living here in Canada. So, oh no, I'm not allowed to invest in tax-free savings account. Yeah. There is no restriction. If you're a resident of Canada, you're able to invest in tax-free savings account. But you need to think about what the consequences of that are. It's tax-free in Canada, so you're not going to pay any Canadian tax on the earnings in that tax-free savings account. But it's not tax-free in the U.S. That does not mean it's a bad deal to invest in, because remember I said earlier that our goal here is to reduce your overall tax. Reducing your Canadian tax to zero doesn't help you if you still have to pay U.S. tax, and reducing your U.S. tax to zero doesn't help you if you still have Canadian tax to pay. So your goal is, with a tax-free saving account, typically individuals resident in Canada, their Canadian tax will be their high tax. So a tax-free saving account allows them to reduce their total tax in Canada and reduce their overall tax. We want to make sure that any saving they make in Canada isn't compensated by an increase in the US tax. So the big secret here is, if you're going to invest in a tax-free savings account, you need to also have what in Canada we call an unregistered account, an account that's fully taxable in Canada. And you'll use the taxes you pay on that non-registered account to offset the US tax on your tax-free savings account. As just a rough order of thumb, I'd say, if you're going to invest $1 in a tax-free savings account, you should invest at least $1 in your non-registered account. That's not always the perfect answer, but that kind of gets you in the ballpark, saying that's what you need to do. You can invest up to $80,000. I think it's $81,500 if you've been a resident of Canada since 2009. You can invest $81,500 Canadian into a tax-free saving account. If you do that and you're a U.S. citizen, you should be investing about an equivalent amount into a non-registered account. It's the right answer. Now, one of the other reasons people say I shouldn't invest in a tax-free saving account, because they said, my accountant tells me I have to file a 3520 and a 3528. These are IRS forms. And, when anybody speaks in numbers, they're just kind of masking this whole, it's a complex form. Let's put it that way. And there's if you look at it, says how long it takes to prepare. It says, 2 hours to prepare the return, but 30 hours to understand the law. That's probably an understatement there. But so these are complex forms. Tax-free savings accounts are, under Canadian law, are trusts. Remember I said earlier, that's not the issue. The question is, what is it for US tax purposes? The US issued a ruling on, not on a tax-free saving account, but something similar to that, interesting, something called a fideicomiso. It's a Mexican trust. And basically came to the conclusion that it did not have to file a 3520 or 3528, and tax-free savings accounts fit in the same category. Should US persons hold tax-free savings account? Yes, for all the reasons we just talked about. But remember, you got to manage your investments. And remember, if you have a PFIC in a tax-free saving account, you're back into those PFIC problems. So a tax-free saving account doesn't protect you from the issues we talked about earlier. Couple words on Roth individual retirement account. They're tax-free in the US. They're not in Canada unless you make an election. So, here's a plug for all us cross-border tax people. You got to make the election. And if you don't know how to do that, talk to someone who does. Also, don't contribute to a Roth IRA, or for that matter, a real IRA while you're in Canada. You can make a contribution to a Roth IRA while you live in Canada. You can make a contribution to a traditional IRA in Canada. The question is, why would you do that? It's not creating a tax advantage for you. Unless you have the unusual situation, your US tax is higher than your Canadian tax. That's pretty unusual. So we could talk a lot about this subject, but I'll pass it off to Chris to talk about RESPs.
Sure. Yeah, I'm just going to touch base quickly on the Roth IRA. I know that there was some questions before the webinar that people were saying, I forgot to do it. What happens? There is a possibility to write to the competent authority and ask for a late election to be done with your return. But as Warren said a few times, if you've contributed during a Canadian residency, the election is void and null. So you don't even bother making a late election at that point.
Yeah, remember that these instruments are anything that has a tax deferral associated with it. You're going to remember which tax you're trying to defer.
Yeah.
And in most cases, your goal as a U.S. citizen resident candidate is deferring the Canadian tax, not the U.S. tax.
Exactly. So our last subject of today, and as we said, these are 30,000 foot. There's some big subjects all on their own. Is an RESP versus the IRS 529 plan, which all intents and purposes they're the same, even though different. They're the same in the sense that you're saving for education.
Krista, you know how I hate acronyms. I looked at this acronym, said I never even said what it is. We've got a bunch of people here in the US
registered education savings plan.
Yeah, so the Canadian equivalent, if you will.
Yes.
Yeah, sorry, that's my fault.
That's okay. So our RRSP is a bad thing. The US actually took a position a couple of years ago where they changed the rules that if a US person had been reporting the RRSP as on the 3520, 3520A is on the foreign trust reporting forms, they no longer need to treat these instruments as a foreign trust filing under those rules. And that's a pretty important thing because we do have some US citizens who have not done their disclosures and are going through a voluntary program under the streamline. They don't meet this qualification. They still have to treat the RESP as a foreign trust reporting. So going forward, is it a good idea? Well, you know, you get the grants, you get the money from accumulating the income. Where is the downside? And this is somewhat similar to the TFSA position in that the income is taxable on an annual basis to the person, the owner, so the parent, the individual US person who actually owns, if you will, the grantor of that trust. Usually it's the parents, maybe it's a US citizen grandparent, whoever is the person that establishes this RESP and contributes to the RESP for the purposes of a child going to school in the future, that income is going to be includable on that person's return. Now, as Warren alluded to with the TFSA, if you have non-registered investments, maybe it's a good idea to still do it because you're going to offset the deemed income that's included on the US return. And you're not really ending off in a worse position. What you may have done is used up some foreign tax credits that could have been potentially used against other type of income. But if you're in a situation where you're continually building more Canadian tax than US tax, it's not always the worst result to use your foreign tax credits to offset some of this deemed income inclusion. Similar to all other investment tools, you've got to be watching for those PFICs, hence why we started with that subject, because it always pops up underneath these different types of investment tools. So even you may have this reporting here, it still branches off into the reporting for everything else. So you have to really watch for that reporting and what type of tools are being invested in those. The US 529 plan, which is the education plan, Canada, for all intents and purposes, doesn't like those. Those are actually going to be treated as a deemed resident Canadian trust, or a factual, actually not deemed, it's going to be a Canadian resident trust. Why? Because you're going to have a Canadian contributor and potentially a Canadian beneficiary. So you're now reporting a foreign trust return for this education savings plan, which is no longer going to be a tax-free position or tax-deferred position, if you will. The income is going to be taxable annually in Canada, not taxed in the US. So this is a prime area of extra reporting and extra double tax. So the 529s, you really need to be careful about if you're moving to Canada. If you have one, what do you want to do with that? How much money is it making you? And it always comes down to that cost benefit analysis. How much tax is it going to cost me? How much administration cost is it going to cost me? Am I still ahead? Those are calculations you actually need to look at. Am I still ahead? is the end answer when you're really trying to make a decision on any of these investment strategies that exist. Where am I at the end of the position?
Yeah, ideally with 529s, I mean, the first choice for, this particularly with US citizens that are moving to Canada in advance of the move, they'd say, what does it cost me to maintain the plan? And can they, what's the cost of actually, dissolving the plan in advance of coming to Canada? And then if they can't dissolve or the cost is too high, what's the cost of the maintenance, the administration? And say if they have 3 529 plans, let's combine them into one 529 plan. Mm-hmm. And so, you're talking about damage control. Now, Krista, you said Canada doesn't like them. That sounds really tough.
It's prejudiced.
I know we have American viewers here, and Canada loves your 529 plans, but it does tax the heck out of them. So yeah, that's really what she meant.
That's right. So there's lots of reporting and lots of tax. Yeah. And one thing I should point out with the RESP, and I said that the owner, the grantor, whichever is reporting the income. It's important to note that when the child, if it's a U.S. Citizen child, the income is taxable in Canada, but it's not actually taxable to the child in most cases in the US. So that's where you get the offset, where you want to make sure that the owner is able to use foreign tax credits because they're taxed to two different people in the different countries.
Yeah, that doesn't sound good.
It doesn't. No, we're coming up to the end here. As I mentioned at the beginning, take the time to fill out the survey. Please give us some feedback. Let us know some additional subject matters that you would like discussed. We have another webinar coming up in a couple weeks on cryptocurrency for US and Canadian reporting and where that is at. Also, if you have any questions on in-tax opportunity strategies, within the survey, there's a part there to ask questions. Just please make sure that you give us your name and contact information so that we're able to reach out to you and answer any questions or potentially set up a consultation and figure out how we may be able to assist you in your future strategies. We are going to stay online here for a bit and answer some additional questions. I know that there's been lots of questions coming in throughout the session, and we'll do our best that we can, but if we're not able to get to them all, we'll make sure to reach out and discuss the questions with you. So Kathy Lee is on the line here. Kathy, do you have any questions for us at this time?
Yes, Krista, we have quite a large number of questions. Everybody was very interested in today's topics. A large amount of questions actually came regarding PFIX. That was quite a popular one, as we would have.
Go, Warren, go.
So one of the questions was, is there a PFIC issue if the funds are held within an RRSP? That was quite a popular one.
Yeah, that's a great question, actually. We didn't say that there. If it's held in an RSP, there is not a PFIC problem because what happens is all the income in the RSP comes out essentially, I'm going to call it for simplicity, as a pension payment. And so it loses that PFIC attribute. So that's exactly correct. And I appreciate the audience staying on their toes. I should have had that on the slide.
That is a good question because that is true. It's protected.
Perfect. Thank you. Another question we have is, as California does not recognize the Canada-US tax treaty, would a Canadian mutual fund within an RSP be considered a PFIC, or even without being inside an RSP?
That's a really interesting question. I know we've got some people in California online, so I'd love to ask if I can call a friend on this one, but I don't think I can. That's right. California does not, it just views the RSP as another investment account. What I don't know offhand is I do not think that California actually adopts the PFIC regime, but it does tax the income in it. So, if you want to answer that question, we'll try and get back to the listener on it, and I'll call my friend in between. Actually, some of my colleagues down in California, they're online. So
sounds good. Another PFIC question we have is, are segregated funds or insurance contracts considered PFICs?
Segregated funds are an easy one to answer. The question there is, are they a corporation? So it depends on the formation of the entity. So they could be a PFIC. And the question is what are they? You have to really look at the details on that, see what they are. But and the goal is not that they look like a mutual fund. The issue here is, what is the structural formation? So if it's held in a trust, my first thought is you've got a problem with that. It probably is a PFIC. If it's not held in trust, if it's held in a partnership, for example, that's fine. That's not a problem at all.
Perfect, thank you. And we'll ask one last PFIC question before we move on to a different topic here. What is the solution to a PFIC? Is creating a C corporation within the US and running the business through that going to help?
Well, if it's a PFIC for the US citizens, also a PFIC for the US corporation. So that doesn't solve that issue. But if you're talking about like having a business that, I saw one of the questions in advance talked about saying, should I incorporate my business because, I may be subject to PFIC or the controlled foreign corporation rules. And, there's always a threshold for incorporation, whether you're a US citizen or a Canadian. The same issues apply, saying is, why am I incorporating? And the tax benefits and the other primary reason why people incorporate is to create limited liability are still relevant. But on the tax one, I wouldn't incorporate a business because I'm going to make $5,000 a year. I might incorporate if I'm going to make $50,000 a year. I probably would incorporate if I'm going to make $500,000. So there's some thresholds there. Using a U.S. corporation to do business in Canada when you're a resident corporation is a tactical disaster. There'd have to be some very unusual circumstances, because now you're into Canada's foreign accrual property income rules, or the FAPI rules, as they're called by people like me. That's not a good solution.
Well, and Warren, I'm just going to add a little bit more. You need to be careful what you're trying to work around. It goes by that same thing that we talked about earlier, a U.S. citizen using a U.S. address. Are you using a U.S. corporation to kind of get around certain rules? Because even though, sometimes we think we're great at, and there are some loopholes that exist out there, you really need to be careful that the loophole there isn't that small little law that closed that loophole to stop you from doing something.
Perfect, thank you. So moving on to REITs. Do rights distribution retain its character like capital gains, or do you look at cash distributed and reported as a foreign dividend income?
Is this for Canadian REITs?
Yes.
Well, remember, for US tax purposes, if a Canadian REIT is actually a corporation, which in most cases it is, that distribution that for Canadian tax purposes is a capital gain or ordinary income. For US tax purposes, all a dividend. You can't pay out something other than dividends unless it's a return of capital. And the US has very specific rules about return of capital, that you cannot return capital for US tax purposes until you distribute all the earnings. So it's almost always going to be a dividend for US tax purposes. It does not retain the income that was in the REIT. So you're not going to get capital gain treatment in the US out of a Canadian REIT.
And I mean, we talked about briefly that the REIT may be a PFIC too, so you need to be careful on all of that, right? So
yeah, if you think about the REIT being for US tax purposes a corporation, regardless of whether it's a PFIC or not, like I say, you don't get corporations can't distribute capital gains, and that their shareholder doesn't get a capital gain from that corporation. They only get a dividend.
Great, thank you. And if you own a REIT, mutual fund, or TFSA, do you have to file IRS Form 3520?
I think we talked about that briefly throughout the webinar, and that do you have to file it? And
well, a REIT isn't a trust.
No,
It's
yeah.
a trust under Canadian law, but
It's
it's
a
not a trust for
corporation.
US tax purposes, so there's no trust there. A PFIC, again, is not a trust. It's, and what was the other one, Kathy?
No, it was TFSA and RESP, I think. Is that right?
Yeah, and you answered the question, the RRSP is not required to
Yeah.
file. And
That's right.
for a
As long as
TFSA,
as long as you have been reporting it.
yeah, and a TFSA would not be required to file a 3520. Again, that's premised on the Mexican land trust ruling that the IRS made. And I want to say that was 2012, something like that. I should be able to cite that, but I can't.
Perfect, thank you. If a US person immigrates to Canada and brings an IRA or 401k, what are the departure tax implications? This one's quite an interesting one.
You want to take that, Krista?
Sorry, if someone moves from the US to Canada, what are the departure tax rules in the US?
So when they immigrate in and brings their
Yeah.
IRA and 401k, if they leave Canada again for departure tax purposes, what would the implications be?
I can jump on that. If they leave Canada within 5 years, there's no implications at all. So secondly is the presumption here, and I'm reaching a little bit on this one. I don't know that I've had something with that scenario, but my expectation is they're going to be treated as like a pension account, a retirement account, and those are exempted from the departure tax implications. What you need to be careful of here, we've been focused on US citizens resident in Canada and their kind of cross-border issues, is the issue is going to be, what does Canada think that thing is? And, we're giving a question, obviously, without knowing a lot of facts, or an answer to without knowing a lot of facts here. So I think there's some more nuance here that's probably relevant if that's your situation.
Yeah, I think, like you said, Warren, generally pensions are exempt from departure tax in Canada if you leave, and especially if you've only been here less than 5 years, that pretty much everything that you owned prior to coming would have been exempt. So there might maybe need a little bit more details to determine that.
I know we're past 10 o'clock here.
Yeah.
And we'll take a couple more questions.
Maybe just take a couple more questions. I know there's quite a few, but like I said, we'll do our best to follow up with people individually if there's some general questions that you need some help with, and see how we're able to assist you.
Sounds good. Here's another question. For US citizens in Canada with available investment capital under 2 million, what approaches do you suggest to prevent the cost of professional IRS reporting from severely impacting investment returns?
Sorry, that was a pretty loaded question. So you have a US person resident in Canada, their estate is worth less than $2 million. And how do you invest to limit the IRS reporting? Is that what I heard?
Mostly to prevent the costs of reporting from impacting the amount of returns.
So the amount that someone's worth, it doesn't really matter to the IRS for purposes of reporting. Unfortunately, you can be a person who has a $10,000 investment account with a bunch of $10 mutual funds, or you could be a person with $20 million of investments. The reporting is going to be the same. So that's where, when we were talking throughout this whole period of time with each different analysis, you really want to be making sure you have a good team of advisors on your side who A, can talk together, B, be able to balance the financial return with the actual cost of reporting that asset or the investment. Now, I mean, generally stocks are decent because they're treated, for the most part, depending on what's in them, the same on both sides of the border. So you really, I mean, that's one area. However, as a lot of people know, that might be more risk, right? So you really, I don't know that there's the right answer for this. It's about balancing.
Yeah, maybe I can give some thoughts on this. I think I have clients that are US citizens resident in Canada, and they come and saying, they ask that question essentially, not necessarily giving a $2 million threshold, but I said, they say their tax stuff is really simple. I said, no. you misunderstand. Yeah. You're a US citizen living outside the US. Automatically, your complexity skyrockets. It doesn't
That's
go up by 2. It goes up by 5 or 10.
Yeah.
You know, if you lived in Lincoln, Nebraska, your filing costs would be easy because you'd have all your investments in the US. You wouldn't have to worry about, you know, Canadian tax. You probably wouldn't have accounts outside the United States. So the fundamental thing is they're a US citizen resident outside the US. That is their number one issue. And from a tax compliance and cost perspective, one of the things, and we haven't talked about this at all today, but we will do we're going to do a webinar later this year on it, is renunciation of US citizenship. Now that's a big, that's more than tax issue, but they can save money on their tax compliance costs. This is the tax they're paying. They say, well, I don't pay any US tax. Well, yeah, their US tax is they have to write their tax return, prepare a check every year. That's a multiple of what it would be if they lived in the US. That's the tax they pay for being a US citizen living outside the US. And, you know, that the issue there is saying is they can avoid that by renouncing their US citizenship. Now, that's a whole subject by itself. Like I said, we're going to do a webinar on that later this year. That's more than a tax issue, but it's something that if you intend to live in Canada for the rest of your life, you have to look at the cost of compliance is significant. Even if you're doing it yourself, the cost of compliance is significant because it's complex. So,
You know, Warren, you say the cost if you're doing it yourself, and the one thing I always caution people when they make the decision, the devil's in the details, and what you don't know, you don't know. And the IRS is not too friendly to those who accidentally miss foreign reporting. Their penalties are quite extensive compared to Canada. In the most part, a minimum of $10,000 per form per year. So it costs more to make a mistake than anything. So I think we'll just take one more here. I know there's still tons of questions, and I really appreciate everybody and their questions. So maybe just one more here, Kathy.
Sounds good. That was a great answer. So the next question is, if a person moves from the US to Canada and they have their IRA and 401ks, can those accounts be merged into a Canadian retirement account?
Yeah, I mean, I talked about that a little bit when I was discussing the RRSP versus the IRA and the 401k. It is possible to roll them over, not necessarily merge them, but roll it over into the Canadian retirement account, the RRSP. There is a provision that allows you to do that with the Income Tax Act to make it non-taxable in Canada because the income's not includable. As I said earlier, where you really need to watch for is the US is still going to tax that distribution, and you need to be able to use that tax in order to reduce other Canadian tax that is otherwise payable, or you could end up in a situation with double tax because Canada will then tax that RRSP withdrawal in the future. So you don't want to have a situation where you're paying the US tax today and the Canadian tax in the future, because that's creating a double tax and overall net worse result for the individual. So a lot of times people just choose to leave them. I know there are banks down there that say you have to take them out. That's not the case. That's just that bank's policy that they cannot manage that fund for you or the policy for you anymore. And you can look for an advisor that potentially can continue to manage that fund. So I think we'll leave it there. Thank you very much, everybody, for your attendance today. We really appreciate the participation and the amount of people that joined us today. It's wonderful when there's participation and interaction. Please reach out if you have any questions. And for the questions we did not get to, we'll make sure to reach out to you and see if we're able to answer your question, or someone from our team will. If it's not Warren or I, will reach out to you to assist with your question. Thanks, everybody.
Thanks very much.
Have a good day.
Okay.